Right. All right, and probably slowly start to see people trickling in. Give everybody just a moment to get in and get set up. So, Chris, they're in Arizona. I'm in Birmingham, Alabama. We have people continuing to come in, so we're going to give it just a moment as people are getting settled in before we get started. So, what is what's we'll give that the super cliche. How is the weather there in Arizona?
Shoot, it's about that time where it's starting to heat up, and I'm sure some of our investors are seeing already. We're getting those AC calls starting to come in. We had a bad week of it last week where people are turning it on for the first time and experiencing some issues. So our AC guys have been busy, but we had a nice little cool down over Easter weekend, so that was great. And then still not quite into the hundreds yet, but low 90s, getting toasty.
Yeah, yeah, yeah. Very cool. We're going to throw up a poll real quick. We're just going to give people another minute or two to jump in before we get going. So we're going to throw up a poll. Really curious to hear from everybody here. How long have you been investing? So we got investors on this call. Curious to know, how long have you been in the investment game? Are you new to it? Have you been in it for a long time? We'll leave that poll up just for a moment, give everybody a chance to respond before we get started. We're going to give it about another minute before we get going. And
How's
then
things
we'll
in
have,
Alabama?
oh man, it's Birmingham is it's always humid, so it doesn't matter what time of the year it is. It's always going to be super, super humid. But same thing here. We're starting to get, the place warmed up a little bit, and we don't have spring here. We go straight from slightly chilly and humid to immediately into summer and humid. We'll get about a 4 day bridge where we'll have decent weather, but it's already unbearably hot. So that's
Yeah.
where we're at with that. All right, we're going to go ahead and get started. As people come in, they can catch up. This is also on demand. So as people join in, they can choose to start from the beginning or a little bit later. So we'll keep things rolling. First thing, just wanted to say thank you for coming. Obviously, Chris and I appreciate you joining in. If you have any questions, we're going to run through a lot of information. We're going to talk about the Phoenix market. We're going to talk about investing strategies. We're going to talk about lending products. If at any point in time you have a question, feel free to go ahead and drop that in the chat. We've got Laura behind the scenes. She's going to be moderating for us. She'll be making sure that we're aware of those questions. If they're pertinent to the issue at hand, we'll try to address them on the spot. Otherwise, there will be a time at the end where we'll address all questions. So you can save them for later or go ahead and drop them in when they come. So what we're going to talk about today, we're going to talk about, who does lending for investment properties, talk a little bit about who Lending One is, which is who I'm here representing, talk a little bit more about Stratton for those of you who may be familiar with Stratton but don't know in depth what Chris and Damon are doing there. Then we'll talk a little bit about that, why you might want to put your properties into the name of an entity if you don't have it already, the difference between DTI and DSCR qualified loans, different investment strategies, different investors and what they use, different types of loan products that we offer, and then, like I mentioned, we'll have that Q&A. So the first thing up is talk a little bit about Lending One. So that is who I am here representing. My name is Josh Hines. I'm the Vice President of Partnerships with Lending One, where Stratton is one of our partners. And so they obviously work with a lot of investors. We also work with a lot of investors nationwide. And so we wanted to come and bring you this webinar to be able to hopefully be a informational and educational webinar for you. So we are a private lender, a direct private lender, have done, 10,000, more than 10,000 loans to date. We are headquartered in Boca Raton, Florida, but we have offices in Charlotte, North Carolina as well as in New York City. We've been doing this for a long time. That the little piece down there, 8 years in business. We're actually a little over 10 years in business now. And then we do on average well over $1 billion in loans to repeat customers. So the investors we work with come back to us time and time again. We'll get a little bit more later on into what it is that we provide. But then want to hand it over to Chris. Why don't you tell, for the people who know who you are but might not really know who you are, why don't you take a moment just to reintroduce them to Stratton?
Yeah, and just want to say we're really excited about our partnership with Lending One and providing some more value to our owners and investors. But here at Stratton Vantage, we've been in business for 20 years. My name's Chris Goodman. I'm the designated broker. I say we've been in business for 20 years. Actually, we've been in the industry for 20 years. Stratton Vantage as a company has been in business for 12 years. And there's a lot of us here that have over 20 years of experience in the property management industry. And we're not just a rent collector, we're a full service property management company. So we handle everything that your investment property would need, from helping you price your rental, get it ready for rent if it's not quite ready. We handle the advertisements, showings, tenant screenings. We place tenants in the home and handle all the paperwork as far as the leases go. Once a tenant's living in the home, we'll do interior inspections, making sure that they're taking care of your property. We handle any maintenance requests that might come in during that time. And then obviously our goal when your tenant's in place is to try to get them to renew and stay as long as possible. And if they move out, we start the process over again. And one of the things we're learning about the property management industry and how long we've been doing this is it's always changing. There's different regulations. And one of the big things we've seen the last couple of years is just the available tools and softwares that are available to owners. And we're taking advantage of learning these new tools. There's a lot going on with AI. What we're really trying to do is just help and make sure our customers have the best possible experience when they're working with us and as we manage your investment property.
Yeah, I love that. And so now you've heard a little bit about us. So let's take a look at the results of the latest poll. So you know how long we've been in business and how long we've been doing what we've been doing. So yeah, it looks like most of the people on the call are old salty veterans. So we've got a number of people. 17% have been doing it 2 to 5 years, 33% between 5 and 10, and then half have been doing it for more than 10 years. So that's really, really cool. Hopefully you'll be able to still glean some information from this conversation today. There's always something, but beautiful thing about real estate, Chris, is there's always something new to focus on or to learn about.
Yeah, that's the truth. And I know we have a lot of investors asking about different investment opportunities, and the financing is a big part of that. So that's what we're going to talk about today.
Yeah, for sure. So, you know, the question comes up, who funds residential investment loans, right? And this is sometimes it's pretty clear and obvious, sometimes it's not. So we'll just kind of run through these. The first one is you can obviously fund opportunities out of your pocket. You know, this isn't, you know, if you can put that cash to work and it's the best return on that, fantastic. Some people do and don't have this luxury. So that's more bespoke, just what works for you. The other is friends and family. I don't know how many people are bold enough to employ this strategy. But Chris, hey, if you got an uncle or an aunt or a cousin that's willing to loan you money, I mean, why not?
Yeah, no kidding. I need to start making some phone calls.
It can make Thanksgiving a little bit weird sometimes if that's not performing well, but you know, you never know. The other is obviously local banks. And so just for the purpose of this conversation, when you hear us talking about banks or banking in general, we're referring to your local community bank, which might be, you know, Main Street Bank that has one, two, or three branches. We're talking about Wells Fargo, Chase, larger national banks, and we're also talking about credit unions. So we kind of lump those in to one category for the purpose of this discussion. When you hear us talking about banks, those institutions are what we're referring to. And then the last way that you can get funding for your investment property is through specialized lenders. So private lenders, like what Lending One does. And a lot of people, when they think about specialized lenders, they think about hard money. And hard money is typically going to be a high net worth individual or a family office locally that has 5, 10, 15, $20 million that they're looking to loan out on a short-term basis just to get some type of a return on their funds that aren't currently in use. The other category of specialized lenders is what we do. And so a true direct private lender that loans nationwide. And we'll talk a little bit about what those differences look like. And Chris, as we look at, the type of lenders that your investors can attach to within these criteria, these are important categories: speed of funding, interest rates, paperwork, being focused on the investor experience. And then the last one that says requires an entity, we'll get to that one just in a moment. But when you look at these criteria and you're thinking through the lens of an investor, the people that you work with every day, what do you think are the things that they should be most focused on in these categories?
Well, the biggest one we're hearing about right now is owners and investors interested in on what the interest rates are doing, and does it make sense to buy right now with getting a loan with these interest rates? How do the numbers work? Can I cover my mortgage with the rent because I'm going to have a higher payment due to interest rates, or do I need to kind of take a step back and wait and see what rates are going to do? And then speed of funding is a big one too. How fast can I get that loan? I don't want to miss out on an opportunity because it's going to take me too long to get the financing in place.
Yeah, no, that's great. And that great dovetail into what we're talking about here. So, what are banks great at? Banks, they've never, look, I don't know if y'all know of any banks that are super fast, but banks aren't known for their speed. They're not known for reducing your paperwork, not known for working with investors, but they do have great interest rates. And that's a great reason to operate with a bank. The other side of that is hard money. So when we talk about that high net worth individual or that family office, they're going to move really, really quick, and they're not going to care much about the paperwork. They're going to understand what it's like to work with investors, but the interest rates is where you're going to pay for that premium at. And so a lot of what we talk about, Chris, with Lending One, and a lot of our discussions have been as we've been, developing this partnership, is how we can hopefully provide value by being a bridge between the best of both of those worlds. And so with somebody like Lending One or a private lender, you get the speed of a hard money person with the interest rates we'll talk about here in just a moment of banks or other similar assets. We don't really beat people over the head with paperwork. We know what it's like to work with investors because that's all we work with. We don't do owner occupied loans. If you come to us and you want to borrow money for your primary home, we don't even do that. We only work with investors, and we only work on investment properties. Now, the one thing that's unique here is you see at the very bottom, we require an entity. And Chris, we have a lot of people that talk about, okay, I've got my properties in my personal name. I don't see any point in putting them into an entity. And when we talk about that, we often are asked, what are the reasons that people put their investments into an entity? And look, we're going to move through this quickly, but this is not, they see a little asterisk down there. This is not intended to be investment advice, legal advice. We're not tax attorneys. You should consult all of those professionals. But for the investors that we work with, and Chris, who you work with, the primary reasons that people put their properties into an entity boil down to a couple of things. So the first is really natural, right? Liability protection. Why would an investor care about their liability?
Well, there's a lot of risk involved with owning an investment property, but great reward. So what we want to do is try to limit that risk. And one of the things you can do is hire a property management company, right? And then another thing would be to put your property into an entity. It provides a layer of protection where your personal assets are protected. If someone were to come after you, they can't come after your personal assets. They're only going to be able to go after the business, and so the entity at that point.
Yeah, absolutely. And then privacy, right? I mean, look, if I am going to be renting my house out, part of my concern is, and one of the reasons that people find value in property management is because they're recapturing their time and they're also recapturing their privacy, right?
Yeah, and a lot of owners don't know this. So we write the lease. We're the layer of protection between the owner and the landlord, or the landlord and the tenant. But on the actual lease, the lease is between the landlord and the tenant, where the landlord's name is spelled out. So if you have it in an entity, it's going to be the entity name and the tenant's name versus your personal name. So the tenant obviously gets a copy of the lease, and if it's in your personal name, they're going to have your name and be able to look you up if they needed to.
Man, that's incredibly important. Great detail. And then one of the things that we talk a lot about on the financial side is separating your personal and business finances, because the last thing that you want to have is for well, this is two parts really. One, if there's an incident and there's a lawsuit and there's discovery, it's going to be important that these things are completely separated. But in addition to that, it's just good business practice to have your personal finances detached from your investment finances.
Yeah, and then your tax person at the end of the year will appreciate that too, just to keep things clean and separate.
Yeah, 100%. And then finally, it also qualifies you for a business purpose loan. And so the last thing that, getting back to what we're talking about, the differences between the different lenders, lending one is a private lender. We're known as a business purpose lender. And what that means is that we can't close in the name of an individual. We have to close in the name of an entity. So a trust, an LLC, a corporation, we have to close in these entity names, not in your personal name. And so you're probably thinking, hey, that sounds great because my bank tells me that we can't do that, but we'd love to. Well, that's one of the reasons that private lenders like us exist. And so just to talk briefly about the difference between the different loan types that business purpose lenders like Lending One provide versus commercial lenders. The first commercial lenders are all using DTI, right? So debt to income, your debt to income ratio. Most people are familiar with this. If you ever bought a personal home yourself, then this should ring true to you. What most people aren't aware of, though, is the DSCR loan. And so the DSCR loan stands for debt service coverage ratio. And then the way that these are calculated, the debt to income is pretty straightforward. You're looking at very simply your total debts divided by your total income, and that gives you a ratio of how much of your income is spent on debt obligations. DSCR is very different, though. We're not looking at your individual income. We're looking at the rent. So the DSCR ratio is very simply calculated by taking your rent and dividing it by your PITI. If you're not familiar with PITI, that's principal, interest, taxes, and insurance. And so for a very simple illustration, if you had a $1,000 rental, and then your mortgage on that property were $900. Now we're talking about maybe in the 1980s, but you're going to have a coverage ratio of greater than one, somewhere in the 1.1 neighborhood. And so for debt to income, these are using your personal income. They want to see your tax returns. They're going to put the loan obviously in your name. They're going to report it to credit. The value of a DSCR loan through a private lender like Lending One is that we don't care about your personal income. As a matter of fact, we don't ask to see your W-2 or your tax returns. That's how little we care about it, because it has nothing to do with the property, because we're underwriting the property based on the value of the asset itself. So we're also not putting this in your name, so it frees you up to be able to have your credit available. And then we don't report this on your credit. So long as you don't default on your payment, you're never going to see this loan associated with your personal name. And we only require a 1x coverage ratio. This is dependent on your credit score, but if you have decent credit, we're only going to require a 1x coverage ratio. So that means that if you can rent a property for $2,000, $3,000, and the mortgage on it is $2,000 or $3,000 respectively, then we're going to loan on that asset. Because again, it's based on the asset, not you. So Chris, when we tell people about this, a lot of investors are really surprised naturally because they're just not aware this type of product exists.
Yeah, and honestly, when you were telling me about it, I wasn't either, and I see this as a great opportunity for our investors, and even some of us here in the office have gotten excited about it. But it's a great opportunity, and which makes our interests aligned with yours, where we're trying to get the most rent that we can for you out of these properties.
Yeah, 100%. And a lot of people, they see this and they think to themselves, well, crap, that may, I'm going to be paying a fortune if I'm going to get a loan that's based on the asset. They don't care about my name. They're not going to put it in my, I mean, surely this is going to be a massive premium. I got to pay for that. But the reality looks a lot different. So what you're looking at here is the difference in a traditional mortgage, so that's your blue line, and a DSCR and an hour. So I can't speak for other private lenders. There are some other people that do what we do. We're just the largest in the country that does it. But for what we do, you can see there the difference in the interest rate. And we track this over a rolling 12-month period. And you can see there are certainly times where you're going to be paying a little bit more money for a DSCR loan or a little bit less money for a DSCR loan in comparison to your bank. And by the way, these are for, your banks. This doesn't take into account how many investment properties you own. A lot of times when you go to a bank and this is your second or third investment property, you may be paying an additional risk premium on your interest rate. And so let's pencil this out and take a look at what this may actually look like. And so just to give you an idea, these are not going to be realistic values you're going to find in the Phoenix market or really anywhere across the country. But to give you an idea of what the difference looks like, if you were to go with a conventional lender, and all of these examples you can see there at the bottom, we're using the example as a $300,000 purchase price with a 20% down payment. And this illustration is not going to include taxes and insurance. So just want to throw that out there as a caveat. But you can see here the principal and interest, and this is, by the way, these rates were as of Monday this week. So this is fresh data right off the press. If you go to your bank and you try to get a $240,000 loan, this is what you're going to be looking at. Your principal and interest is probably going to be in the 6.9 range. Closing time on investment property is going to be 45 days. That may be a little bit generous. You may be looking at closer to 60 days, depending on your bank, how often they've worked with you. Origination fees are going to be anywhere between 1 and 3 points. Those may be baked into the rate that you don't even see, but they're going to exist somewhere. And then you can see there, we're using the 1% rule. Again, that's very, very difficult to find nowadays. But if you could rent this property for $2,400, you can see there what your cash flow would be. So now let's look at if you were to use Lending One, our DSCR loan, just using the asset to cover it, the difference in that. So you can see there is about 4 basis points or 0.04% difference in the rate that we had versus your conventional lender. But you can see there our closing time is about in half the time. Our origination fees are going to be less. And the actual cash difference is, you see there, about $6. Now, one of the things that we have the luxury of doing at Lending One that other people don't, again, keep in mind, we are an asset-based lender and we are a private lender. This is our money. We're not lending agency-backed paper, so we don't do FHA loans or anything of that kind. And so what that does is it allows us the flexibility to go in and create unique loan products because there are a lot of markets across the U.S. that are having a hard time cash flowing through investment properties, but these markets are appreciating over time as well. And so what we did is we went in and created a 30-year fixed rate loan, but the first 10 years of that loan are interest only, and then it amortizes over the last 20 years of the loan. And so the reason that we wanted to provide that is because a lot of investors, the data shows us that they're either going to refinance or sell their investment property in a 5 to 7 year window. And so by having a fixed rate loan on the front end, it allows you to get into an investment that you may be interested in and allows it to boost cash flow. Now, you're not going to get the principal pay down, but look at the way that this same example is going to edit your cash flow. You can see here, there's obviously a little bit of a premium that you're going to pay to get the interest only part of this loan. Still the same low closing time, but look at the way that it's going to boost your cash flow. And so again, this is on an example of a $300,000 property and a $240,000 loan. So the higher that goes, the higher your cash flow is going to be. And so you can allow those properties to cash flow over time. And then when interest rates drop, you can refinance. Once you gain some of that appreciation in that property, you build equity through that appreciation, then you can still pull cash out at a later time. So that's just kind of a general overview of what this might look like. But really what we want to do, Chris, is we want to give people an idea of, why Phoenix, why Stratton? And Chris, you've been doing this for a long time. You work with investors coast to coast. You're managing properties for all those people. You see what's on see what's happening, boots on the ground. And that's the a huge advantage for the people listening into this is being able to hear from a true market expert in that market. So let's talk through this. As we talked about designing this, one of the first things that we wanted to talk about was being a long-term buy and hold person. But why?
Yeah. It's weird asking your property manager maybe for some investment strategies, but I always encourage our investors, whether they're using us to acquire a property or not, reach out to us first. It happens all the time. Where we'll get a property that we onboard, and it's a property that our investor just purchased, um, and their sales agent promised them this high amount of rent, and that it would rent in 10 days, and it's going to cash flow all this money, where they don't have to manage it after they sell you the property. They're trying to make the sale, and then they send you off to the property manager, and now we're trying to get your property rented with some unrealistic expectations on the rent. So we're here to help with acquiring properties as well, and we do have some good advice. And I do like the long-term buy and hold strategy. One, just because you can weather the storm of the different cycles. So we know that real estate in general is going to fluctuate. Like right now, we're seeing where homes are sitting on the market a little bit longer. Where if you were to have bought an investment property a year or two ago with the hopes of selling it again in another year for this high profit, probably not going to be there. But over time, values appreciate. And so, what we want to, some of the areas that we like to focus on when you're looking to purchase a property are some of those that are on the outskirts of the Phoenix area. So, a city like Buckeye or Queen Creek or Goodyear, these are areas where you're going to have higher appreciation opportunities because they are developing. They're a little bit further out, so the acquisition cost is usually lower. But you'll see there, Buckeye on the west side. Our inspectors always make a joke that, hey, I got to head out to Buckeye today, so while I'm there, I might as well stop by Disneyland because it's a little bit further out on the west side of the valley. But going out there now versus 10 years ago, I mean, the shopping's there, the stores are there, the infrastructure is there, housing is there, and so there's some good opportunities in these towns that are on the outskirts of the valley. Queen Creek, a one that I'm partial to, 10 years ago was just farm fields and single roads in and out, and now you have Costco, and once you have a Costco, you've made it big. Costco and Target and shopping, all of the things, it's growing, and it's even going further down south into that Santan Valley area. Goodyear's another great one. So a lot of opportunity when you're looking at these areas on the outskirts, and as they're developing, the appreciation will be there, and people are still moving there because, again, they're nice areas, and they have that value with lower costs for right now. Although Queen Creek's getting up there where rents are even spiking a little bit. So
And this is the incredible opportunity for the people who are listening, either live or going to be listening on the recording. This is the value in having a market expert because Chris and his team, I mean, they are looking across the entire, Phoenix metro on a daily basis. They understand what's happening, they understand the trends, where different neighborhoods are moving, and this is the type of conversation that every investor should be happening with all of the real estate experts in their life, but certainly the ones that are managing those assets. And so this conversation should be happening a couple of times a year. So I'll pause real quick, ask Laura if you will. We're going to throw up one more survey, get a couple of responses. What are your plans for this year? So you investors, you're sitting there and you're thinking, you know what, 2025, we just started Q2. There's a lot of room to go. What do you want to do? Are you looking to shed some properties? Are you looking to add a couple of things? Do you want to maybe do a little bit of both? You trying to move in and out of some different assets, or do you just want to kind of sit by and just wait and see what happens? And we'll keep moving. We'll leave that up for just a moment, and we'll keep going in the meantime. And so, yeah, we talk about the growing areas, but then there are a lot of areas where the demand for these rentals is extremely high.
sure, yeah. So those areas on the outskirts can be great opportunities as far as acquisition costs are going to be lower, and then appreciation opportunities is greater. But your more central cities like Gilbert, Mesa, Tempe, Scottsdale, while you're going to pay more to get into those properties initially, you're usually going to attract a longer tenant, a tenant that's going to stay longer. You're going to be able to get a lot more in rent, and there's just a higher demand for those areas. So usually if a home becomes available in those areas and it's priced right and looking good, it's going to rent. Um, and we always encourage investors, and that's why that interest only opportunity is a great product from Lending One. If you can get into a property and cash flow, that way you're making some money while somebody else is paying off the mortgage. So we're looking for those opportunities whenever they're available.
Yep, indeed, indeed. And then the next thing is, hey, look, there's nothing that matters more for a market than jobs, right? And the economy. And what does that look like?
Yeah, and so like right now we're seeing where investors are a little bit shy with hey, my property is not renting like I thought it would. Is it time to sell and get rid of this home? But everything that we're seeing as far as the Phoenix area goes is the supply is going to get soaked up. There are people moving here because of jobs. There's jobs here. Some of the major employers that are coming are Amazon, Apple, Google. Um, I have about a 20-minute drive on my way into work, and on that drive, I'm passing major industrial complexes. And at first, I'm thinking, who's moving into these places? They're just going to sit vacant. But every time I drive by now, there's a new company moving in, and companies want to be where people are going to be, and people are going to be where the jobs are. So the more that we see these companies come in and providing jobs, that's just going to be great opportunity for housing, and where the tenants are going to be is where the jobs are going to be.
Yeah, and to give kind of a different overview of what that looks like, you can see here, obviously there's as the unemployment rate, there's a big spike there from COVID naturally across the country. But then you can see that the job market in and around the Phoenix area has been extremely stable over the last 5 years and is only getting better because as you look over to the other side of this, jobs, as you were mentioning, Chris. I mean, jobs and employers, a chicken and egg, right? One's always chasing the other, is always chasing the other. And so you can see this increase in the resident population over the last 25 years has been on on a linear upward trajectory. And there's a lot of value in this. I mean, people, you should not walk past or sleep on the fact that this is a continually growing market over the last 20 years. I could show you a lot of different markets that we analyze on a regular basis here at Lending One that show the exact opposite path of this. I mean, look at a ton of the major metros in California, a lot of the major metros in Texas, a lot of the major metros in the Northeast are trending in the opposite direction. So, be thinking about, what is the next, not just what is today and tomorrow and next month and next year going to hold, but where are these markets moving over decades? And that's a great indicator of where your activity and your mindset should be. But we're talking to seasoned investors, so we're preaching to the choir here. But it's super important though that we recognize what cycle we're in, right? Are we in a softer market, a firmer market? Is it where is the pendulum swinging? And I know you've certainly got some thoughts around that.
Yeah, we've had a few investors the last year or two, I would say, that wanted to try and test the waters with selling their property. They've owned it for a long time, and maybe it sat vacant a little bit longer this last vacancy than they wanted. So I don't want the stress of it. I'm just going to go ahead and try to sell it. And we're seeing actually a lot of those come back to us and say, hey, I can't sell my property right now. Let's go ahead and get a tenant in there. And so I do feel it is more of a buyer market right now. So that can be a great opportunity to acquire another property. We're seeing builders, whenever you see builders offering incentives, that's a good sign, where they're offering rate buy downs, appliance packages, all sorts of different things. And then on the resale market too, it gives you some leverage with negotiation. So we hadn't seen where sellers were providing closing costs. We're seeing that now. They're willing to provide home warranties on homes. Um, they're willing to do the repairs that the buyers are requesting. So you can definitely capitalize on the opportunity for it to be a buyer's market on the resale side of things as well. And then no one can really predict the future. I'd like to say now's the best time to buy. I know there's a lot of people that are waiting for it. They're thinking that the price is going to go down a little bit more. But what I say is if it's an opportunity that makes sense, where the rents match up with what your mortgage is going to be, act quick because you don't know how long this is going to be available. Um, and you got good resources behind you with lenders that can get you the loan and get it done quickly. And then we want to make sure we're getting you in those properties that make the most sense as far as being able to get them rented quickly, and keep a good tenant in there long term. And so if you have any questions about acquiring properties, we definitely can help you out there. We have a real estate agent. Her name's Mary. This is Mary. Some of you may have already met her or know her. Anyone that I've ever introduced her to or referred her to has instantly fallen in love with her. She's great. I don't hesitate to recommend Mary to anyone, but she's very familiar with the valley, some of those areas that we spoke about. If you let her know what it is you're looking for, what your goals are, she can help you find it. She's been in real estate for a long time, and she loves working with clients. A lot of times they become friends, and I see the letters and the reviews that get written to Mary on at least weekly basis, and people love her. So if you want some information, we're going to have her contact information at the end of this presentation on a slide. She'd be happy to speak to you about any questions you might have regarding our market.
Absolutely. And this is a great opportunity to let's take a look at that poll. So as we're thinking about buying and we're thinking about selling, what is it? So wow, we've got not so many people are thinking about just selling, but it looks like we've got a little bit of a mixed bag. A lot of people want to add some properties to their portfolio. Some people want to do a little bit of both, and then some wisely so, we're sitting by and saying, let me see how things play out. There's nothing wrong with that, Chris. And what we want to do is we want to have conversations, right? If the conversations with Mary, if the conversations with Chris, it makes sense just to talk, right? I mean, to pick up the phone, call, and talk through what you have going on, what you're thinking, because, I know, Chris and these guys, they're at the end of the day, they're in it to be a resource. And if the best thing for you is to 1031, or if the best thing for you is to pick up another property, they're going to guide you, because I know, they're relationship driven people, and relationship driven people are thinking about the best value in a 10, 20, 30-year relationship, not just necessarily how they can transact on a daily basis. So reach out and have those conversations ASAP. So one of the things we'll move on to talking about is the different types of investors, right? So if you're an investor, you probably fall into one of a couple of different avatars that we've created, and these are all going to seem pretty familiar to you. The first is the rehab specialist. So these are people that are addicted to short-term flips. So obviously, a lot of you here are long-term holders. If you've got a property manager, that makes sense. You also may do flips. And so if you're somebody who's looking for value-add properties, obviously Mary's a great person to be able to connect in with to see where are some markets, what are some streets that you might can get some value. And if you find one, Lending One has a loan program for that. So we do have a fix and flip, what's also known as a bridge loan. We can deploy money quickly. The reasons you might want to do that is because we can move very, very fast. Oftentimes we can close on a fix and flip property in as little as 10 days. Use somebody else's money. You might have $1 million sitting in the back seat of your car, which is fantastic. But you can use that $1 million to go buy a couple of properties, or you can use it as leverage to go buy many, many properties. And so you can spread that money out over time. So the way this works is, if you find a value add property that you can purchase, we'll loan you up to 90% of the funds you need to go and buy that property. And then we'll loan you 100% of the rehab cost. So if you find a property you can flip, and it's, for instance, $300,000, and it needs $150,000 renovation, we're going to loan you 270 of that $300,000 for the purchase price, and then we'll give you the entire 150 to go and renovate that property. And all of those funds that are set aside for renovations, you don't pay interest on these, but these are interest only, short-term loans that are intended to get you in and out of a property really quickly. And so, Chris, I know that, Phoenix isn't known as a super distressed market that has a ton of fixer-uppers out there, but there's some opportunities.
Yeah, and now having a product like this, if an opportunity arises, it's something we can take advantage of for sure.
Yeah, absolutely. And so, if you're not on the flip side, like we said, you're probably, if you're on this call, you're probably going to fit into the long holder category. So this just means that you're buying stuff to hold it. You want to systemically build wealth, take advantage of the different tax benefits that come along with it. And so if that is your plan, then we've got a product for that. So it's our 30-year fixed rate DSCR loans. We talked about the underwriting criteria for that. And why would you want to do it? Well, one, if you go to a traditional bank, once you get to a certain threshold, you can no longer buy properties through an agency-backed loan. So most banks are going to cap you at 10 rental properties owned. But beyond that, once you own a couple, if you're getting stressed on DTI or you're tired of what the bank is putting you through to grow your portfolio, that's why lenders like us exist. And so, same things we've said before. We're not worried about you personally. We're basing the loan off of the asset itself. We're very flexible in the types of terms that we can provide. If you're looking to buy a property, we'll go up to 80% leverage on a new purchase. We'll go up to 80% leverage on a rate and term refinance. So if you happen to have a poor interest rate, which I hope that you don't, I hope you took advantage of the wonderful boom that happened in refis during the COVID period. But if you need to get a rate and term refinance, we'll do that up to 80%. And then if you want to take cash out, if you've got a lot of equity sitting there and you're thinking, hey, man, Chris, I didn't realize that these markets existed, and I'd love to continue to invest in the Phoenix market. I'm a little bit locked in. What can I do to pull some of this equity out? We have cash out where we can do cash out refis. So even if this property is in your personal name, you can do a cash out refi and redirect it into an entity at closing. That entity doesn't have to exist today. So you can pull those properties out, do a refi, take some of the funds. There's no restriction on the funds. Take them to hopefully go and buy another property. So we have interest only options available, as we discussed before. Most of these are 30-year fixed rate. We have very low seasoning requirements. So if you have any of those specific questions, don't hesitate to ask. The rates themselves are based on a simple matrix of looking at what is the personal guarantor. So although we're closing in the name of an entity, we need a personal guarantor on that loan. That personal guarantor's FICO score is one criteria that goes into what your rate will be. The other piece of the criteria is the leverage. So when we talked earlier about a rate being at 6.9 as an example, if that's good credit at 80% leverage, you might not need that much. So if you go down to 60% or 50% leverage, that rate's going to continue to move down with that. So obviously we know a lot of people are out here holding, and that is what everybody on this call specializes in. You as the listener, Chris is the manager, and us as the lender. So if we can ever help, certainly be happy to with that. And then the other side of this is Chris, I think where there may be some real opportunities are the people who are looking to recycle that capital. And these are your BRRRR, right? These are people who are looking to buy, renovate, rent it, refinance it, and then repeat, right? You want to do it again. And so if you're looking to cycle that capital, we have a bridge product that's kind of the best of both worlds. So if you're looking to go and buy a fixer upper to put some money into to get it right, and then turn around and have Chris manage that on the back end, we've got one streamlined process for that. And so you don't have to worry about going and getting a little bit of money for the purchase, using your credit card for the reno, and then using a banker on the back end. We can do it all in one process. Basically, the way this works is you get a lot of discounts, right? You don't have to pay, for instance, for 2 appraisals. You get the appraisal on the purchase. When we turn around and we refinance that into a 30-year mortgage before Chris takes it and starts managing it, then you don't have to pay for that second appraisal. Where a bank would ask you to do it twice, you don't have to do it. And there are a lot of different ways that you can save on fees like this. So you can see here, a lot of these conditions are the same as our fix and flip. Is just a blend of those 2 products together. And Chris, there are always opportunities. If you're at the doorstep of the courthouse, or if you're just perusing through Craigslist, I don't even know if that exists anymore, then you can find opportunities. If you could think of a neighborhood or an area, is there anywhere in the greater Phoenix area that people could be thinking about as a broader street area neighborhood where they could potentially find some value add properties?
I think the west side has some opportunity there, and I hate to even say that because I feel like they could be at any part of the valley, not just the west side, but some of the older parts of the valley. Mesa has some parts that are older. where you might have somebody that lived in a home a long time, didn't put any money into upkeeping it. Now they're trying to get rid of it, and you have the opportunity to go in and buy on an established street, an established neighborhood, fix it up, and then turn it into a rental. So I think that opportunity could be anywhere in the valley.
Yeah, and what we're seeing from the data that we have is there is a ton of deferred maintenance out there. And so investors now that were able to sit on their deferred maintenance and then sell it, irrespective of how much deferred maintenance there are, now you've got more savvy buyers that are coming in. And so that could be an opportunity for people to get in at a good price point, put in a little bit of reno work and have a great rental on the back end.
Sure.
So the last thing we got here is you may be somebody who considers yourself a collector. And so some people collect baseball cards, some people collect cars, some people collect toys, some people collect homes. And so naturally, if you're an investor on this call, you have at least one. And so if you're looking to continue to scale and diversify and you want some mitigation of risk in your portfolio, we have a product that's pretty specific to that too. So the advantage to our portfolio loan product is you can close multiple properties in one loan. So this can either be done through a new acquisition or it can be done through a portfolio refi. And there are discounted fees. Naturally, if you think about economies of scale, you're going to get a significant reduction to the fees associated with these loans when you're closing multiples together. And you can have, so we talked about the debt service coverage ratio, and we talked about the requirement that you have a minimum of 1 times for any individual asset. What's unique about the portfolio loan product is you can have multiple assets in that portfolio, and some of those assets can be underperforming. So you might have a loan in there that doesn't even quite cover its cash flow, but we can group it in so long as the aggregate of the entire portfolio covers its cash flow. And so a lot of advantage for that. And it's one origination process. It's one underwriting process. It's one monthly payment. So it just makes things a little bit more convenient. And so these come in 30-year amortized loans. This is the same thing that you're going to see from the DSCR as before. The only difference with this is you get a slight reduction to your interest rate because you're putting them in a portfolio. So you get them a little bit cheaper. We have 30-year fixed rate. There are also non-recourse loans that we have available. So if people are looking to buy many properties, you might be an investor that has the capital and you just need a little bit of additional debt to go out and buy 50 units. And if you want to do that, that's great. We loan anywhere from a minimum of $70,000 up to $200-300 million. So there's quite literally nothing that you would need as an investor that you need funded that we wouldn't be able to help you with. And then you can see here very similar terms to our standard DSCR. We go up to max 80% leverage on a new portfolio purchase. We'll go up to 75% on a portfolio refi. So you may be an investor that's aggregated properties over the course of the last 10 or 20 years, and you have varying degrees of equity in every property, and you have varying degrees of interest rates in every property. You can bundle these up into one portfolio refi, pull some cash out to go a little bit faster and buy a little bit more. And then last thing is, won't spend much time on this, but if you're interested in doing ground up new construction, if you're buying infill lots and you're, as an investor, if you're wanting to buy and build, either building to sell or building to rent, the good news is Chris and them can help you either way. So they can help you on the takedown side. Mary can help you get that house processed. And then if you want to turn it into a rental, then Chris and team can obviously take care of you there. Yeah, so why would you want to use us for your capital needs? Well, as we've talked about, we loan nationwide. We've been around for a long time. You don't have to worry about our capital. So if you come to us for $100 million, we're going to make sure we got that $100 million in the bank that you need. Where some of those what's considered hard money guys, you get in with them. Sometimes if they only have $20 million to loan out, they may want to loan you the money. They may have thought they had the money at the beginning of the process, but on the back end, not so much. So yeah, this was great. We've got a couple of different pieces of contact information here. First, wanted to look, obviously, Chris, his email, his phone number there. If you have any questions, please reach out directly. I know that he would love to have that conversation with you. Mary, as was mentioned earlier, if you're interested in any of those markets in and around Phoenix, either on the buy or the sell side, Mary's a great contact. And then here at Lending One, We've got you have through our relationship with Stratton, you've got a dedicated loan advisor. So we have a lot of people that are working on loans nationwide with investors everywhere. But for you guys in particular, we have Scott Wolf, who is dedicated to the Stratton channel. So if you ever have any questions, there's his email and contact information there. If there's ever anything you can do, if you're just curious about a quote, if you want to look to see how a property might pencil out, please don't hesitate to let him know. And so, yeah, we're. It looks like right now I don't see any questions in the chat. So we'll wait around another minute or two and see if there are any questions that come in, either about the Phoenix market, what Chris has going on, about the Lending One products. Or if that is all for you, that is all for us. We will follow up with an email, so you'll get an email of this recording. You'll also get the contact information that is on here. You'll be able to see that contact information come through your email as well to make sure that you're well connected. So we'll hang tight for another moment. But if you are done, then we are done. So we'll give it just a second. Looks like we've got one question that came through. Do you have a product for ADUs? The short answer is yes. We do have a product for ADUs. It really depends on how the lot is parceled, but that would be a great question to reach out and talk to Scott specifically about your what you have in mind. But thank you for the question.
Yeah, the thing I would add too is don't let the requirement of the property being in an entity scare you away. That's something that if you don't already have properties in an entity, we can recommend somebody that can help you with that. It's an easy enough process. We definitely recommend it. We have investors that are contacting us all the time that have changed the ownership into an LLC. So if you have any questions on that, we can help you out there too.
Yeah, absolutely. That's a great point. So it looks like most of the questions are done. I would say for the people that are watching this on the replay, sorry we didn't get a chance to see you live. Obviously, same information here. Reach out. I know Chris would love to have a conversation with you. We'd love to talk to you about anything that we can help with. But it looks like most of our questions are done. Any parting thoughts for you, Chris, before we jump off?
No, yeah, thanks for your time, Josh, and thanks for the rundown. I think this is going to be a great product that a lot of investors are going to want to take advantage of. So we're happy to be partnering with you on that.
Same. No, look, we want to be in business with people who do business well, and Stratton's had a long running reputation for doing it at the highest level. So appreciate you being here. Appreciate all of you that took your time out of your day to join us. Hope you have a wonderful afternoon, and we hope to be in touch soon. Thanks so much.
All right, see ya.